the component cost of equity. So we are going to be finding the tail end of the weighted average cost of capital equation. There are two components to common equity. There is retained earnings, and we're going to call that R sub S. Now, if a firm has used up all of its retained earnings, it may then look to issuing more common stock if it is in need of capital. Then we will call that R sub E. But this tutorial will focus on finding the cost of retained earnings. Why is there a cost for a firm retaining its own earnings? Well, we already know that a firm's earnings can either be reinvested, and that's what retained earnings are, or the firm can use those earnings and pay it out as dividends. An alternative, of course, is to do a little of both. Investors could buy other securities and earn a return. If the earnings of a firm are retained, there's got to be an opportunity cost. In other words, the stockholders could be buying other securities and earning a return. Other securities, other investments that have the same amount of risk as that firm's stock. So investors could buy similar stocks and earn R sub S, or a firm could repurchase its own stock and earn R sub S. How are we going to find the costs associated with a firm retaining its own earnings? Well, there are going to be three ways that we could attack this. Of the three, two methods we're already familiar with, and the third method is very simple. The first method is using the equation for the CAPM. The second method is what our book calls the discounted cash flow approach. Well, this is just the equation that we used in Chapter 9 for a constant growth stock. However, in Chapter 9, we use that equation to find the current price of the stock. Here, we're going to rearrange that same equation and solve for R sub S, which is the required rate of return that the firm must earn on behalf of the stockholders to keep them happy. And finally, there's the bond yield plus risk premium approach. This one is super simple, where we take the firm's before tax cost of debt and we add to it a risk premium. But the risk premium in this approach is not the same risk premium as in the CAPM. The risk premium in the bond yield plus risk premium approach is going to range anywhere between 3 and 5%. Most of the time, you're just going to use the midpoint, which is 4%. So, using our example of Coleman Technologies, if the risk-free rate at the time is 7%, the market risk premium is 6%, and the firm's beta is 1.2, we see that the cost of this firm to retain its own earnings is 14.2%. Using the information for the discounted cash flow approach, where the firm's last dividend was $4.19, its current price is $50, and the growth rate, the constant growth rate, is 5%. Well, that growth rate, we know from Chapter 9, is the constant growth rate in dividends, earnings, and price. So certainly, if we're going to use this formula, we need the next dividend to be paid by Coleman Technologies. Well, we're going to increase the $4.19 by 5%. That's our next dividend. Divide that by the current price, add to that ratio the growth rate of 5%, and according to this method, the cost of Coleman Technologies of retaining its own earnings is 13.8%. Well, can this discounted cash flow methodology be applied if a firm has a growth rate that's not constant? Yes, we can, because all stocks are expected to attain a constant growth rate at some point, maybe in 5 to 10 years. And sometimes that's complicated to calculate, but we'll go ahead and go with the discounted cash flow method. We'll accept all of its assumptions. Finally, the last method of finding the cost of retained earnings is the bond yield plus risk premium approach. So earlier, when we were finding the cost of the firm's debt, we said that its before tax cost of debt was 10%. To that, we're going to add this risk premium, which I talked about. It's going to range anywhere between 3 and 5% for this approach. Most of the time, we'll just use the midpoint between 3 and 5. That's 4. So, according to this approach, the cost of retained earnings is 14%. So, we've got 3 methods of finding the cost of retained earnings. We applied them all for Coleman Technologies, and we found 3 different answers. So what are we going to go with? Well, if we have equal confidence in all 3 methods, we can just take the midpoint. We can take a straight average, which in this case would be 14%. Here's another example of finding the cost of retained earnings using all 3 methods. That's problem 10.6 from your textbook.